Welcome to Basic Actuarial Science. This presentation will cover risk assessment and insurance, specifically focusing on probability theory in financial planning. Get ready to explore the world of actuarial science. So, what exactly is actuarial science? It is the discipline that applies mathematical and statistical methods to assess risk in insurance, finance, and other industries. Actuaries use their skills to analyze and manage financial risks. Let's look at some key components of actuarial science. First, we have risk assessment. This involves evaluating the likelihood and impact of future events. Second is probability theory. This is the mathematical framework for quantifying uncertainty. Let's discuss fundamental probability concepts. The basic probability formula is P of A equals the number of favorable outcomes divided by the total number of outcomes. P of A represents the probability of event A occurring. Now let's explore key probability rules. The first rule is the addition rule. P of A union B equals P of A plus P of B minus P of A intersection B. This calculates the probability of either event A or B occurring. Second is the multiplication rule. P of A intersection B equals P of A times P of B given A. This calculates the probability of both events A and B occurring. Here's the risk assessment framework. Risk equals probability times impact. Probability is the likelihood of an event occurring. Impact is the magnitude of the financial consequences. Now let's look at insurance premium calculation. The basic premium formula is premium equals expected loss plus loading factor, where expected loss equals the probability of claim times the average claim amount. Let's dive into expected value in insurance. The expected value formula is E of X equals the summation of X sub I times P of X sub I. Here is a Python example. Outcomes are 0, 10,000, 50,000. Probabilities are 0.95, 0.04, and 0.01. The expected loss is calculated using this data. Here are a few applications in financial planning. First is life insurance, calculating premiums based on mortality tables and risk factors. Second is portfolio risk, which involves assessing investment portfolio volatility and expected returns. Here are the key takeaways. Actuarial science combines probability theory with risk assessment to create robust financial planning models for insurance and investment decisions. You are now equipped with the basics of actuarial science. If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.